Hi everyone, and welcome back to another simple daily practice drill I think you can use to become a better trader. And this one is called 15-minute confirmation. So let's go and take a look. In this video, I want to review some trades, and I want to show an exercise I use to review my own trades using a higher time frame. I think this exercise can help you discover trades. I think it will also help to filter out unnecessary trades or emotional trades which are low probability. I think this exercise should be practiced as a trade review markup at the end of the trading session. In this video, I want to talk about a trade review drill. If you head to my blog, Zen Trading Tech, how to use 15-minute charts to confirm 5-minute trade setups. This is a trade review drill, and I'm going to go through a couple of examples of looking at trades that are marked up on a 5-minute chart and how they relate to what's going on in the 15-minute chart. Now, in this post, I discuss that ideally we're going to work towards this ability to stay in sync with both charts. But when we add new information as well as trading live, we're probably going to hesitate, we're going to make more mistakes. So just bear this in mind. My recommendation is that if this is the first time you've done this, then spend time doing it on charts you've already marked up, and then slowly move to using it when you live trade. If you find that by putting a 15-minute chart next to your 5-minute chart, you hesitate and have a terrible day, well, then you know the cause and you can build it up over time. Here is a 5-minute chart of ES, and I've put some trades, some long trades, some short trades, some exits, some stop locations for us to analyze on the 15-minute chart. Here we can see a reasonable buy attempt. So the top of this bull bar here is the 9 close. So although you could have taken this trade on the 5-minute, getting a 15-minute bar, which is a huge outside bar, big tail above and below, not a strong close, not a strong close above the high, there's a good chance we're going to head back to the moving average. So reasonable if you take that to exit. You can see this trader scalped up. What about this sell here? Well, yeah, it's 3 good-looking bear bars. Is it a breakout? This bar broke out of this, but it didn't break out of the range. One of the problems with taking an early breakout trade is that some of your friends might exit that trade if they get a disappointing entry bar, which is what I think happened here. So you can see that trade on the 15-minute chart, although it was a good-looking bear bar, it didn't break out of anything, and it didn't trigger. So that's the correct exit, I think. You don't get a 15-minute buy, not a great buy the close. Possible to buy above. This is the close of the 15-minute bar here. You can see some traders waited for it to go above and then bought the close. If you took the buy all the way up here, then your stop's down here. It looked like most traders that did that yesterday bought up here and then bought 50%, or just bought the 50% and traded back to that first entry. And this happens a lot in trading ranges. You see a good trade, it fails, and traders are able to trade back to it. What about this sell here? Well, this sell here, you're just selling below a very small bear bar after 2 really strong bull bars. This is probably going to have a second leg sideways to up, and you're selling at the low of that pullback. So if you took that trade on the 5-minute chart, you look across and you see this is your closing bar, a bear doji closes back in the range, then you probably don't want to be holding short, and the trader was right to exit. You can also see this high 2 on the 5-minute chart didn't even register here. So not all of the clear trades on the 5-minute are going to transfer across, break out to a new high, pull back. Traders that are buying in here are not too concerned about this sideways price action. They're expecting a test of the high. Buying here, same again. This high 2 was low in a range. This was at the 50% mark. This high 2 is right at the top of the session. Weak bar triggered, bad entry bar. This bar did not even trigger. So reasonable for scalpers to buy the moving average, but you need to get out when you see that. So that's one way using the 15-minute chart could have helped stay on the correct side. I wrote some notes on the post on my view of some of these trades. Breakouts weren't confirmed, but the stop location was a problem. But we were always in long on the 15-minute chart, and we basically stayed always in long all day. New high, no strong break below that swing point, new high. It wasn't until the middle of the session where we went below a strong swing point. Typical behavior in a broad channel. You go below a swing point, then you get a new high. So you get that expanding triangle look. What about on this chart? If you're following along on the blog post, example 2, trading range open and a bear swing. On the 15-minute chart here, we've got a bull breakout which triggers. Now that's important. If there are bulls that have bought above that bull bar, they're probably going to buy below and a stop down here. And that stop is the 15-minute stop. Now, if I'm trading a 5-minute chart, I don't need the 15-minute stop, but I'm mindful that some of those traders are going to try and scale into that position. 3 consecutive bear bars on the way down, not a great place to sell. Traders want to sell a pullback. Traders selling under bar 3, that's okay. But what happened on these 3 bars? Not much. Okay to exit. On the 15-minute chart, you've got a spike, a pullback, and now you've essentially got a high to buy. That's a reasonable 15-minute buy there. So the trader took a sell, that's okay, it didn't work. Trader took a buy, and I like that the trader exited here when the 15-minute chart said, that's not how good high twos work. Good high twos do this, or they do this. Bad ones immediately drop. And I like that the trader was quick to sell a new low of the day, betting that 15-minute bulls will get out. Breakout, pullback, low one short, another good sell, closing at targets, and then getting back into a short. So even though the first trade didn't work, the second trade didn't work, the trader was able to turn the day green by trading with the 15-minute chart. Once you see this bar on the 15-minute, you've got to expect a second leg sideways to down. Follow through weak bull bar, follow through inside bar. As long as we're not going above those highs, expect more down. There will probably further sells of the moving average, betting we test 5,500. Okay, example 3, trading range open and a bull swing. I've picked some trading range opens so we can see how 5-minute trades fold into the 15-minute chart. So here we've got a bull channel, traders taking profits above that high. If I'm in a bull channel and traders are taking profits above a high, that means I probably don't want to be selling at the low of that channel. It's bullish, it's just not that bullish. Often traders are waiting for 1-leg pullbacks, 2-leg pullbacks to buy again. So traders able to sell here and exit at a low. That's a good trade. This buy here was okay, but if that's your entry bar or that's your follow through bar for a buy up here, you need to get out. Trader wasn't quick enough, they took a loss down here. What I liked is that the moment the trader bought high and took a loss, they no longer look to buy high. And that's, I think, the great tip in this video. If you buy high and you have your stop run, the worst thing you can do is suddenly switch to short here. And the second worst thing you can do is continuously make that mistake. But the trader was able to take that loss, saw the spike, bought the pullback, exit. 2 legs up, sold, exit. Now we've got 4 or 5 legs. It's breakout mode. We're above both moving averages. The trader was able to wait for consecutive 15-minute bars to take a buy, which worked. So I think these are good examples of getting in sync, getting out of sync, and then not repeating the same mistakes. Example 4, bull trend from the open. Consecutive, good-looking 15-minute bull bars going up from the moving average by the close. Strong 15-minute bull bar, and then a pause. So okay for the trader to exit. This is a lot of bars up. You can see if I draw a line right through there, this was a reasonable place. What I liked especially is that this is not a good-looking reversal bar for the bears. Weak tail. Okay to wait and buy again. Exited the high. Nice trade. The trader never switched to short, so that's what I like about this. Even though you're out of longs, you don't suddenly start selling, and then you wait for strong bull bar here, forcing you to buy high in a trading range. This is a better looking buy. This is a better looking buy, similar to these two. So 15 minutes always in long, trader stayed long all day. Example 5, a bull swing failed and then a bear swing. Very strong bull breakout up. So probably always in long, traders buying and buying below. 3 bull bars, traders will buy. But you see the tails on the 15-minute chart, so okay to exit above them. Betting there's not going to be a lot of bulls yet buying above there. Some might hold to see what's there. Other traders will just expect it's a trading range. Pullback, Trader doesn't suddenly switch to short, they buy again, exiting where they got out before. What I like is that even though there are no trades in this area, we were never always in short. Here was the first 15-minute reversal bar. It then got follow through here. So this was a possible short in this area. The trader let it go, wanting to see what happened to the moving average. And now you've got 3 consecutive big bear bars closing below the moving average. Trader waited for a pullback, sold the breakout point from the opening range, sold again down here. So I liked that this trader wasn't rushed to flip back and forth, selling here and it's a bull bar, then trying to buy, then it doesn't work, then they switch. And I think that's good. And the last example, the trading range open. Strong bull spike on the 15-minute chart and deep pullback. By deep, I mean it's gone below 50%. Because it's gone below 50%, that means that traders that scaled in now have a really good risk reward. They've got a small risk and a big reward. That means it's reasonable for them to exit these trades here. So when a trader takes this 5-minute scalp, that's okay. They're going to the high of the day before. We went above it once. We'll probably go above it a second time. It looks like they only closed half the position and then closed the rest here. Quick to exit at the top of the range. They immediately were able to trade it like a trading range. Now this trade could have failed. They could have bought here and it got a follow through for a breakout. They were able to buy low, exit back at the moving average. Buying low again, exiting at a reasonable stop entry in a trend is a reasonable fade in a trading range. Buying low, selling high, buying low, selling high. Sell the close 24 was a mistake. Why was it a mistake? Well, it's a strong breakout bar here, right in the middle of the range. So it really needs follow through. It really needs to change something. You can see over here, sets of 3 bars, a couple of really good bars, 3 bars in a row. Trader realizes they make a mistake and got out, immediately switch back to buying low, selling high. If we look at the 15-minute chart, bear bar didn't break out of anything, bull bar didn't break out anything. So as long as this is a triangle and a tight trading range, it's reasonable to do this. At some point, after double tops and double bottoms, you've got to expect breakout mode. Trader took 35, expecting that the breakout was going to be up, and took a small loss. If you take a loss buying high late in breakout mode, then chasing the breakouts probably what you need to be doing. So they had a chance to sell here or sell here, maybe even 41, betting that all the bulls that bought here are now holding losing positions. But easy to look at in hindsight. So thanks very much for watching. I hope you found that valuable. In this video, we talked about a higher time frame trade confirmation exercise. It's something you can practice for your trade markups. I showed a few examples to give you an idea of how to practice it, and I encourage you to give it a go for the next week and see if it improves your trading. Thanks for watching. My name's Tim Fairweather from Zen Trading Tech.